Most traders think the biggest money is made by finding the right stock. But Jesse Livermore, who turned minimal capital into multi-million-dollar fortunes across multiple market cycles, knew something different. He said, "Whenever I have had the patience to wait for the market to arrive at what I call a pivotal point before I started a trade, I have always made money in my operations." Today, you'll learn the exact principle that separated Livermore's precision timing from the chaos of ordinary speculation, a methodology he developed over 30 years of market study. This isn't about finding winners. It's about entering them at the psychological moment when victory is already architected into the structure. Drop a comment. What's cost you more money, entering too early or exiting too late? Picture the early 1900s. The stock market was a wild west of speculation. Fortunes were made and lost on hunches, tips, and luck. Most traders operated like gamblers at a casino, playing on emotion, chasing movement, hoping for breaks. But Livermore was different. He was building something systematic. After decades of losing money doing what everyone else did, he had a realization. The market itself was sending signals. Price movements at specific levels weren't random. They were structural, architectural moments in a stock's journey. Here's where most traders fail. They enter a position based on the story. The stock is going up, momentum looks good. The chart, no, looks bullish. They buy at $45 thinking they're early. Then it pulls back to $42. They hold. It rises to $55. They think they're geniuses. But they entered in the middle of a move, not at its foundation. The real damage? They miss the backlog of profit, that critical early accumulation that gives you the psychological strength to hold through volatility. Without it, they panic on every pullback. They sell at the worst moments because they never had conviction built into their position from the start. Livermore called this the amateur's emotional poverty. You have position, but no foundation. But Livermore discovered something profound. Every significant price movement has structural points, moments where the market's psychology shifts fundamentally. These aren't random, they're predictable, if you understand what creates them. A stock reaches a certain price level, say $100, this becomes a psychological barrier. When crossed with authority, it signals that something structural has changed. The market is telling you, this is the beginning of something important. Think of it architecturally. You don't start building a house in the middle of the walls. You start at the foundation. Pivotal points are the market's foundations. They mark where new structures of price movement begin. Livermore spent 30 years developing record-keeping systems to identify these points. When time and price merged in his analysis, his records began to talk to him. That's when the real profit started. A pivotal point is a price level at which a stock transitions from one structural state to another. It's a psychological boundary where sufficient buying or selling pressure has accumulated that crossing it signals a fundamental shift in momentum. Think architecturally. You can't judge a building's integrity by looking at the middle stories. You must look at the foundation. A pivotal point is the market's foundation, the level below which the previous trend held, and above which a new trend begins. It's not magic. It's structural psychology hardened into price. Livermore didn't use terms like bullish or bearish casually. He used upward trend and downward trend precisely because they describe the immediate structure, not vague sentiment. Here's what the amateur does. They see a stock rising from $40 to $55. It looks strong. They buy at $50 thinking they're catching the move early, but they're actually in the middle of someone else's move, the move where early smart money already took their profits. The amateur doesn't understand which price levels matter. To them, $50 is just a number. They might buy $47, then $53, then $56, chasing price upward without understanding the structure underneath. When the stock pulls back to $48, they panic because they have no architectural foundation. They bought randomly, so they sell randomly. Worse, they completely miss the real opportunity. The stock rallies from $40 to $100 in a major structural move, but the amateur caught the middle 50 points and got shaken out during a normal 20-point pullback. They were never properly positioned because they never waited for the structure to reveal itself. The amateur confuses the stock is moving with this is a properly timed entry. One is observation, the other is precision. The professional operates differently. They keep records, they document prices, they note time, they watch for patterns. Livermore's method was meticulous. He recorded prices with specific attention to time elements. After 30 years of this work, he developed a principle. When a stock reached round numbers, 100, 200, 300, or hit previously established high and low points, the market behavior at those levels revealed everything about what came next. The professional waits, not passively, but with active surveillance. They watch a stock decline from $100 to $80, then rally back toward $100. As it approaches, they don't buy early at $95 hoping to catch the move. They wait for the structure to complete itself. They watch for specific conditions at the pivotal point itself. When the stock crosses the pivotal point with proper momentum and volume, that's when the professional acts. Not with hesitation, not with hope, with conviction. Because the market structure itself has signaled that a new movement is beginning, the professional has patience as a weapon. And Livermore proved it repeatedly. Let's examine Anaconda Copper, one of Livermore's most instructive examples. For years, the stock had been trading. Livermore observed a simple principle. When it crossed round number thresholds like 100, 200, and 300, remarkable advances followed. In early trading, when Anaconda crossed $100, Livermore placed an order for 4,000 shares. His purchase wasn't completed until the stock hit 105, or just 5 minutes of delay. That day alone, it advanced 10 more points. The following day brought another remarkable surge. The stock advanced to well over $150 in a short period with only normal 7 to 8 point reactions. The pivotal point of $100 was never threatened again. The structure was sound. The foundation held. He repeated this at $200. Same result. Rapid, powerful advance. But here's where the principle becomes profound. At $300, the pattern broke. Anaconda crossed $300, but only reached $302 or $50. Normally, after crossing a pivotal point, you'd expect a 10-15 point advance minimum. Instead, the market was being flooded with shares. Supply was overwhelming demand. Livermore recognized the danger signal immediately. He sold 8,000 shares in less than 2 minutes at $300 per share, with the remainder moving down to $298.50, where the stock closed. Next morning, Anaconda opened substantially lower in New York. Within days, it collapsed to 225. This is critical. Livermore didn't just trade the pivotal point. He watched the follow-through. When the structure failed to confirm, he exited. The danger signal trumped the setup, but Anaconda teaches us only part of the lesson. Because Livermore's greatest trade, the one that demonstrates the power of waiting for perfect structural alignment, came with Bethlehem Steel. And this trade shows you something that most traders never experience. What happens when you have complete patience and perfect timing working together? Because that's where the backlog of profit comes from. Livermore made a statement that defines this principle. It has always been my experience that I never benefited much from a move if I did not get in at somewhere near the beginning of that move. But here's the critical part. Somewhere near the beginning doesn't mean early. It means at the beginning, at the structural moment when the previous boundary has been decisively broken and the new movement is commencing. This requires patience of a different kind, not just waiting passively, but waiting with active observation, watching for the exact structural confirmation. The amateur sees a stock consolidating near its highs. It's been range-bound for weeks. They think, if it breaks out, I want to be in early. So they buy at the top of the range, hoping to catch it. The breakout before it happens. The stock does break out. Initially, it runs up 5%. The amateur feels brilliant, but then something happens that the amateur didn't anticipate. The breakout fails. The stock comes back into the range. The amateur, having bought too early without structural confirmation, gets stopped out with a loss right before the real move begins. Or worse, the breakout succeeds, but the amateur bought before it happened, so they only captured the back half of a 3-month advance. They had capital deployed early, but made only half the profit they could have made by waiting for structural confirmation. The core error, they confused the stock might break out with the stock is breaking out. Might and IS are separated by thousands of dollars per contract. The professional watches the same consolidation. They note the resistance level, say $98. They watch the stock approach it multiple times, but they don't buy until something specific happens. When the stock crosses $98 with significant volume, showing real conviction, they then deploy capital. But even then, they're watching the follow-through. Within the first few hours or days of crossing the pivotal point, does the stock act powerfully, or does it immediately get weak, suggesting the move is dying? Livermore's records were designed specifically for this. He would watch how a stock behaved immediately after crossing a pivotal point. Fast, hard advance with minimal reactions. The structure is sound, enter more aggressively. Weak, hesitant. Action with supply appearing. Danger signal, don't commit or exit what you have. This is why Livermore wrote, "It is significant that a large part of a market movement occurs in the last 48 hours of a play, and that is the most important. Time to be in it. You don't need to catch the entire move. You need to catch the confirmation phase, when the pivotal point confirms the structure is real." Bethlehem Steel in April 1915 is the exemplar. The stock had reached its highest price on record, $87.50 on April 7th. It was consolidating. By April 8th, Livermore had decided this stock will break through $100. That day, he began accumulating shares from $99 upward to $90.75. Here's what happened next. The same day he started buying, the stock shot to $117. 5 days later, on April 13th, it hit $155, a breathtaking, almost vertical advance of roughly 60% in just 5 days, starting immediately after Livermore accumulated his line at the pivotal point. But the story doesn't end at $155. This is where Livermore's patience becomes architectural genius. He didn't sell at $155 thinking he'd caught the move. He held, he repeated his operation at the $200 pivotal point, then again at $300, and again at the dizzy peak of $400. Why didn't he sell after the first move? Because he understood the structure. Once a pivotal point is broken, it rarely becomes resistance again. The $100 point that seemed like a mountain to climb became a foundation that would never crack again. This required supreme patience through massive moves. Every point of advance could trigger fear. Should I sell and take profits? But Livermore knew the architecture. Once the structure confirms, follow it to its logical conclusion. He also did something most traders never do. He applied the same principle on the way down. When Bethlehem eventually declined, Livermore watched as it broke pivotal points in reverse. $400, then $300, then $200. Each time it broke a support level decisively, he exited his remaining position, understanding the structure had inverted. The Bethlehem Steel trade proves something essential. The pivotal point isn't just an entry technique, it's a complete structural system. Entry at the pivotal point, holding through the confirm phase, building position on the way up. And then, this is critical, watching the danger signals when the structure changes direction. But none of this works without one element that most traders completely lack. Livermore spent over 30 years developing his record-keeping system. He wasn't doing it for fun. He was building a tool to make invisible market structures visible. His method, record prices, combined with time elements. Not just the high and low of the day, but when price movements occurred, how fast they were, what patterns emerged. After years of this, something changed. His records began to communicate patterns to him. I found it did not help me to any great extent. Weeks later, I had a new thought which aroused me to fresh endeavors. Gradually, after making many of these, I began to develop ideas I did not have before. When I started to merge the time element with price movements, my records began to talk to me. That's the architecture breaking through. The amateur's error is simple. They don't keep records. They trade on memory, feeling, and gut instinct. They think they're flexible. What they actually are is blind. They make the same mistakes repeatedly. They get stopped out at the same price level 5 times, never realizing that price level represents a structural pivotal point where multiple reversals have occurred. They don't know their own history because they didn't record it. Worse, they accept tips. Someone tells them to buy a stock. They buy. It doesn't work. They blame the market being wrong or the tipster being unreliable instead of understanding that the tip came without structural foundation, without records, without analysis, without architecture. Livermore told a story about a lady at a dinner party who pestered him for market advice. He told her to buy Cerro de Pasco, which had just crossed a pivotal point. The stock advanced 15 points that week with only minor reactions. But the lady had never actually bought the stock. She was waiting to see if his information was correct. First, she missed a perfectly executed pivotal point trade because she had no personal records, no personal study. She was waiting for someone else's conviction instead of building her own. The professional keeps meticulous records. They write down prices. They note when movements occurred. They mark pivotal points. They document reactions over time, and this is the key. It takes time. Patterns emerge. A stock they've been watching suddenly has new prices appearing in their records. The pattern forming looks similar to a previous pattern. They go back through their records and find it. 3. Years ago, a different stock moved through similar price structure at similar time intervals. They learned from that. Now they can anticipate what might happen. This is what Livermore meant by market records that talk to you. You're not guessing. You're reading a conversation your own analysis is having with itself. The market is communicating, but only through the specific language of your documentation. The professional also knows this. Every move of importance is a repetition of similar price movements from the past. Once you understand the patterns in your records, you can recognize them faster when they appear again. Then you can act. Not hesitate, not hope. ACT with precision born from documented analysis. Livermore said, once you familiarize yourself with the actions of the past, you will be able to anticipate and act correctly and profitably upon forthcoming movements. That's not instinct. That's architecture built on evidence. The cocoa commodity market example from 1934-1937 demonstrates this perfectly. For years, cocoa moved within predictable ranges. December options, high in 1934, 623, low, 428. In 1935, high at 574, low at $4.54. Nothing remarkable. These were the documented baseline patterns. But in August 1936, something changed. The market became very different, as Livermore observed. Cocoa sold at $6.88, far beyond the highest price of the previous 2 years. It was breaking through established pivotal points. For a trader who hadn't kept records, this meant nothing, just another price. But for Livermore, watching his documented patterns, this was a structural signal. The market was communicating. Something fundamental has changed. A severe shortage had developed in the cocoa supply. From August 1936 to January 1937, the record-keeping revealed everything. September high 751, October 870, November 1080, December 1140, January 1937 peak at 1286, a rise of 600 points in 5 months. But Livermore's records told him something else. Each of these new price levels was now a new pivotal point. Once the market crossed $7 that became a support level. Once it crossed $10 that became the new foundation. His records were literally mapping the architecture of the move as it happened. A trader without records would have gotten lucky or lost everything. A trader with records would have seen the pattern, recognized the structural breakdown of previous resistance levels, and systematically added to positions at each new pivotal point confirmation. So now you understand, pivotal points aren't mystical. They're not lucky hunches. They're the visible architecture of market structure made clear through time-price recording. But there's one final principle that separates Livermore's mastery from every trader's attempt at copying him. Here's what separates Livermore from ordinary profitable traders. He didn't just know how to identify pivotal points. He knew how to interpret the action at the pivotal point when a stock should break out, but doesn't. When it crosses a pivotal point, but with weak follow-through. When supply suddenly appears instead of explosive demand. These aren't failures. They're communications. They're danger signals. Livermore made this explicit. Bear in mind when using pivotal points and anticipating market movements that if the stock does not perform as it should after crossing the pivotal point, this is a danger signal which must be heeded, not a suggestion, a must. The architecture is telling you the structure is unstable. The amateur's error is predictable. They fall in love with the setup. They've identified a pivotal point. The stock crosses it. They're in the position and they're thinking, here we go, this is the big move. Then something unexpected happens. Instead of the hard 10-15 point advance that normally follows a pivotal point breach, the stock stalls. It's being supplied. Selling is appearing, the momentum isn't there, but the amateur doesn't see a danger signal. They see an opportunity to buy the dip. They add to their position. They're married to the idea that this should work, so they double down betting it will. The stock never recovers. The amateur eventually gets stopped out at a loss, or holds until significant drawdown, having misread the market's communication. The core error, they don't understand that the market is supposed to act a certain way after a pivotal point. When it doesn't, something changed. The structure shifted. The trade is no longer valid. The professional watches the same scenario differently. The stock crosses the pivotal point. They note the time and price. Then they wait for the confirmation action. Within hours or days, the market either confirms the structure is sound through aggressive follow-through, or it signals the structure is suspect through weak action and supply. Livermore's exact words on the Anaconda $300 situation. On those occasions, there was a very fast advance of at least 10 to 15 points right after the pivotal point had been crossed. But this time, instead of the stock being hard to buy, the market was being supplied with quantities of it to such an extent the stock simply could not continue its advance. That's a danger signal in plain language. The market was supposed to be hard to buy, scarce. Instead, it was easy to buy, abundant. The absence of expected behavior is the signal. A professional trading Anaconda at $300 would have recognized this within minutes or hours. Not watched for weeks, hoping it would recover. They would have exited 6,500 shares in 2 minutes at $300, then methodically sold the remaining position down to $298.50. The professional doesn't stay married to trades. They stay married to structure. When the structure fails, they move on. Anaconda $300 is the perfect case study in reading danger signals. From $100 to $200, the pattern held perfectly. The stock was hard to buy, scarce, powerful, advancing rapidly. That's what a successful pivotal point breakthrough looks like. At $200, Livermore repeated the trade. Same result. The market wanted to own it. The stock advanced powerfully with only normal reactions. But at $300, the story changed. The market suddenly had abundant supply. Instead of scarcity, there was flooding. Instead of hard to buy, it was easy to get shares. Most traders would have held, rationalized, and hoped. Livermore recognized that the fundamental nature of the market had shifted. The original thesis, that crossing $300 would trigger automatic strength, had been falsified by market action. He didn't hesitate. He sold 8,000 shares in less than 2 minutes at $300 per share. The remaining 1,500 shares took 25 more minutes to liquidate down to $298.50, but he was out. Next morning, Anaconda opened lower in New York and within days was at $225. The danger signal had been exactly right. The structure was unstable. The architecture failed. This is not failure. This is mastery. The ability to recognize when a structure is working and when it isn't, then act accordingly, is worth more than any single winning trade. Let me bring the complete system together, because Livermore's genius wasn't in any single principle. It was in how they all work as an integrated architecture. The pivotal point system operates as a complete top-down discipline. It begins with observation. You maintain detailed records of price and time. You're not trading yet. You're documenting. You're training your mind to see patterns. From that record-keeping emerges identification. You recognize that certain price levels matter. They've been tested before. They've shown structural significance. You mark these as pivotal points, the architectural boundaries where trends transition. Then comes patience. Most traders think this means inactivity. It doesn't. It means active surveillance with disciplined non-action. You're watching the market approach the pivotal point. You're seeing support or resistance establish. You're not trading prematurely. When the pivotal point is decisively broken, you move to confirmation. The market has a choice: confirm the structure through powerful follow-through or signal weakness through poor action. You watch this moment intently. Hours matter. The first reaction is diagnostic. If confirmation appears, hard buying, rapid advance, absorption of supply, you move to accumulation. You build your position, not all at once, but with conviction, knowing the structure is sound. Then comes the most underrated element: patience through profit. You don't exit at the first 5% gain. You don't take small profits and call it a day. You hold through the structure of the move, exiting only when market action signals the architecture is inverting, the danger signal protocol. This entire system requires something most traders never develop: conviction born from documentation. Not hope, not tips, not intuition. Conviction built on your own record keeping, your own analysis, your own verified patterns. Livermore made this explicit. Few people ever make money by trading on the occasional tips or recommendations of others. They trade on tips, they get killed, because tips have no architecture, no personal conviction, no structural foundation. But when you keep your records and you identify patterns and you execute based on your analysis, something changes. Profits made this way are immensely more gratifying than any from external sources, Livermore said. Why? Because they're real. They're yours. They're built on understanding. This is the complete system, not one trick, not one indicator, but an integrated architecture of observation, identification, patience, confirmation, accumulation, follow-through, and disciplined exit. And so here's my challenge to you. For the next 2 weeks, keep a Livermore-style record. Document one stock or market you're interested in. Write down prices. Note time. Mark what you think might be pivotal points. Don't trade it yet. Just document it. Build your records, then watch what happens. Do patterns emerge? Do certain price levels show structural significance? Do you see the market talking to you through those records? This is exactly what Livermore spent 30 years perfecting. You don't need 30 years, but you do need to start. You do need to move from abstract theory to personal documentation. If you want to understand the complete Livermore methodology, not just pivotal points, but the full market method, read Reminiscences of a Stock Operator by Edwin Lefebvre. This is the foundational text. Livermore himself said his records and this book contain his complete system. And for those serious about implementing the pivotal point technique specifically, I've created a detailed workbook showing how to set up your record-keeping system and identify pivotal points across different time frames and market types. Download it, study it, use it. Here's what separates the professional from the amateur. The professional has personally verified their methodology through documentation. They don't trade on hope. They trade on evidence. If this changed how you think about market timing and entry precision, hit that like button. Subscribe for more deep dives into legendary trader methodologies. And drop a comment. Which principle was most eye-opening to you? The pivotal point identification, the patience requirement, the record-keeping system, or the danger signal protocol? I read every comment. Remember, this video is for educational purposes only. This is not investment advice. Jesse Livermore's strategies require significant study, personal practice, and discipline. Market trading involves substantial risk of loss. Never risk more capital than you can afford to lose. Always conduct your own thorough research and consult with qualified financial advisors before making any trading or investment decisions.